Okay, so good morning again. I'm Bill Bonk with the uh, TTI Group HR organization. I'm Director of Global Benefits, and some of you are new to this program, and some of you are veterans. And this presentation is really intended to provide an overview to refresh your memories and educate those who are new to the program. I've been administering deferred comp plans longer than I care to admit, but in all that time, one thing for me is always seems to rise to the top, and that is you get the most out of these types of plans when you have a plan that you're working against. You can simply defer for the sake of deferring, and that's fine. You don't necessarily have to have a, a no flexibility in your plan. You have to be able to dodge and weave as your circumstances change. But a plan of some sorts is always the best approach to this. So I'm not a financial planner, but I can work and I'm willing to work individually with each and every one of you, to talk through a plan of some sorts. Or I'm also happy to talk to your individual financial planners if you have that to make sure that they understand how this program works and that whatever is works best for your personal objectives. So I'm on slide 2. This is what we'll cover today. What is a deferred comp plan? Why do we have one and how does it work? The risks associated with it. There are some relatively low risk, but there are some that you need to understand. The tax consequences, and then an opportunity to ask questions. So if I could defer for just a moment and talk about a 401k plan. 401ks are highly regulated. They are subject to discrimination tests. You have to have a balance between the highly compensated and non-highly compensated in terms of how what the deferrals are. Those of you who are who've been in the 401k 3, 4, 5 years ago know that some of you have gotten money back because of that discrimination testing results. Last year we passed 100%, so things are getting better there. But a non-qualified plan isn't subject to really any of those requirements. They are they're non-qualified as far as the government's concerned. They're really controlled by the SEC and are subject to the rules and regulations around what you can do with your money in terms of deferring it and continuing to get a tax advantage. To try to keep you from playing games with that. So the biggest difference between a 401k and a deferred comp plan is the timing required for decisions. So if you can keep that in the forefront of your thought process as we go through this, we'll talk a little bit more about that. But you can enter a 401k, change your percentages every week, come in and out, doesn't matter because it's surrounded by a group of regulations that don't let you outside of that bubble. The deferred comp plan doesn't have that bubble, and it is a different animal in that respect. Also, if you got an invitation, an election, it is you are eligible for this program. It's a limited group of select executive level senior staff chosen at our discretion, and it changes every year. That's why we have new people in it. Slide 4. I wanted to update everybody on the new 2018 plan limits. The most compensation that a 401k plan can now have is $280,000. Any amounts above that are not considered compensation as far as the IRS is concerned. The annual limit moved from 18.5 up to 19,000 for next year. And the non-discrimination testing limits and all that is lots of numbers and rules and regulations around that. But If there are no amounts that can be matched under a 401k above 280,000 because of these limits. A very simplified example on chart 5, on the left side and right side are pretty much the same as far as base bonus and total earnings. So this individual makes 300,000 a year. On the left side, if there were no limits, you could your whole 300,000 would be eligible. You could defer 8% of 24,000 and match 12,000. Well, when you put the limits on that the 401k plan requires, your eligible earnings drop from 300 to 280, and your pre-tax limit of 19,000 only allows for a match of 9,500. So the deferred comp plan sits on top of the 401k. It is a completely different plan. It's not a 401k plan. It has its own documents and everything, and we'll talk a little bit about that. But so effective earnings, in order to get into the deferred comp plan, your base plus bonus has to be 237,500 or greater. Because if you divide 19,000 by 8%, you get that number. So that's sort of the tipping point of when you start becoming eligible to put money into the deferred comp plan. So again, I'm on slide 6. By contrast, the deferred comp plan is different than a 401k. We talked a little bit about that. You can elect, you have to make two decisions. You can elect to defer some or all of your bonus from 0 to 100% of your bonus. That's payable in the first quarter 2019, but you must have made that decision by June 30th. So you probably got an invitation from me back in June to do that. I talked with a whole bunch of you about the pros and cons of that, because again, you have to complete your participation under the 401k before you can be eligible for any matching contributions for the deferred comp plan. So most of us don't make that by the time bonus hits. Many of us reach that point with our bonuses, and some of us don't reach that point until at various points throughout the year, and we monitor that. But in order to defer any of your bonus, this is an SEC requirement where they make you make that election irrevocable 6 months ahead of time of the plan year. As far as base pay is concerned, you have to make that decision really before the plan year starts. So we have until December 31st, but we try to wrap that up by November because it's a manual process. There's a whole bunch of administration that takes place after November 30th, and so we'd like to have everybody's decision by the end of that time period. If by chance you do or don't make a decision by November 30th and you want to have a discussion on joining the plan or changing that election, just give me a call. We can probably do it, but we just want to make sure that we have all of the decisions, as many as we can, by November 30th. Once January 1 starts, you're done. You can't make any changes. You're locked in for the plan year. This year, as in the past years, these are made by forms, and you should all have your forms. If you don't have them, I'm happy to send them out again. And I am very excited that we're moving to T. Rowe Price, because now we'll be in a platform where this can once again be automated. Transamerica was just not able to complete the programming, and we had to move away because some of the complexities. We had to move away from an online enrollment to a manual enrollment, and it's just been a royal pain, but we've managed our way through it. We're going to go back to that for the 2019 bonus paid in 2020. So this will be the last year for forms. uh, yay for me, good for you as well. On slide 7, um, on your paycheck, once you hit the 401k max 19,000, deferrals will automatically start. Again, so we monitor that. You don't have to do a thing. It'll show up on your paycheck just like a 401k deduction, but it'll be called SUP retirement. And the same record keeper. We're moving this whole plan from Transamerica over to T. Rowe Price, starting that conversion will start the middle of December. You get earnings and losses. It'll look just like your 401k, but it'll be a completely separate account. And you'll have to toggle back and forth between the two. I think T. Rowe Price will show both your entire savings plans, both of them on a combined screen. Not really sure about that. Just like a 401k, you can split your investments. The reference investments are very similar to the 401k. We don't actually fund or hold money in a cash in a trust like the 401k plan. That's very different. This isn't, this is deferred money. You don't, as a participant, you don't have constructive receipt of that money, and until you do, it's still the company's money, but it's being invested in your name, and earnings and losses are applied based on the decisions you make around the investments. We maintain a balance sheet. Each division has a separate balance sheet for the value of that your participant account. And we can talk a little bit more about that later on. Slide 8, this is how you put money into the plan. I've already talked about some of this. So this is a general unsecured liability that's owed to the employee. And this is, I guess I'm gonna slide off here, sorry. The risks associated with the deferred comp plan. Again, it's not formally funded, no assets are set aside. The bottom line risk here, the takeaway, is that in the event of insolvency, as a participant in the deferred comp plan, you become a general creditor. Unlike a 401k, that money is yours, cannot be accessed by any outside companies or organizations that are trying to get money out. It's reserved, it's in a trust, it's your money, can't touch it. Deferred comp plan is a little different in that it can be touched in the event of insolvency. So that's really the takeaway and bottom line, and that's probably the biggest and only risk that you need to get comfortable with as you participate in this plan. Okay, slide 9 talks about tax consequences. The deferrals and matching contributions, if any, we've always made matching contributions, and the formula is exactly the same as the 401k plan, but they're not subject to federal and state income taxes when you defer it. Earnings or losses are not subject to federal and state until distributed, just like the 401k. And the contributions that when you take them out, contributions are, I'm sorry, when you contribute, they are subject to Social Security and Medicare taxes at the time that you defer them. Okay, slide 10. This is how you put money in. You can defer on your base pay, you can defer from 2 to 90%. The reason we don't go to 100% of base pay is because you need to have something to pay those Medicare and FICA taxes. So we stop at 90%. You can put 100% of your bonus in. So deferrals start only after the threshold of 237,500 is reached, and you must sign up for the 401k at 8% to maximize the full match potential. If you're at 19,000, or too early in the year, let's say you put in 10 or 12%, you won't get your full match, right? Because you'll hit the $19,000 ceiling before the match is calculated at the full uh, uh, 90, 95, 9250 this year. So you're encouraged to sign up for the 401k at 8% so that you maximize the match, and then it'll automatically start contributing to the deferred comp at whatever contribution level you choose to put in. Most people who participate in this plan put in 8% 401k and 8% deferred comp. That maximizes the full match potential. On your bonus, you can defer 2 to 100% of your annual bonus. And then every December 1st, we don't match on a regular basis for the deferred comp. As you'll notice in the 401k, we match every pay cycle. Once you start with the deferred comp program, you won't see a match until sometime in December. We do the calculation, we project it to the end of the year, and we make the match based on the same formula as a 401k. You cannot take out any loans. You can't take withdrawals at any time out of this plan. We'll talk a little bit more about taking money out here on slide 11. So this is another, remember earlier I talked about the one of the restrictions is the timing of which you have to make decisions on. And it gets a little complicated, and again, I'm at your disposal to have a better understanding of when you can take money out, but there are some high-level dates and things that if you keep in mind, it'll help you work your way through this. You can take a distribution when you terminate employment, and then you're paid 6 months afterwards. Or you can pick a fixed date that's at least 5 years after the date you would normally receive the base or bonus. Okay, so the 5 years is a magical number. Everything that you do with respect to picking a date that you're going to get money out of this plan, think of it in terms of 5 years. We'll go through some examples in a second here. And also, you can pick either to have that in a lump sum or annual installments from 2 to 10 years. It's a once a year annual installment, and you can pick 2 to 10 years. Okay, let's go on. Termination of employment. One of the things that you need to keep in mind is that once you pick a distribution date for, well, it says this bonus, but I use this same presentation for that back in June. You can't, base or bonus, doesn't matter. You can't change that distribution form or form of payment in the future. You're done. You're locked in, and it's over with. Now, that's the decision, that's the requirement for that year, for that election. You have to make elections every year. So you can pick termination of employment one year, you can pick fixed date the next year, you can change that around. But for that particular deferral year and for that particular election of termination of employment, you can't change that. If you pick a fixed date, you can re-defer later on. So that's part of the flexibility of this program. As you go through and make your elections every year, you can, if you have a plan, you can stagger those payments out of the plan based on your retirement plan. And for everybody, that's going to be a little different. So let me just give you a quick example. So for 2019, let's say you decide to participate. 2019, you say, I want to participate 8%, and I want to defer for 5 years So you would put 2024 in that slot. Let's say then in 2021, you decide you want to push that deferral out beyond 2024. Your only choice is to do 2029 or later, meaning it's at least 5 years. You can pick 5, 6, 7, 8, 9, 10. You can push it out as far as you want, but not beyond age 65. But most people generally do the 5-year plan. Gives them some flexibility so as their things change. However, your decision to push that out farther beyond 5 years from 2024 to 2029 has to be made 1 year before your distribution is originally scheduled. So in the original example, you picked, your 2029, you wanted it deferred to 2024. By December 31st, 2022, you need to tell us that you want to defer that beyond 2024. I know it's a lot of numbers, but you have to give us a 12-month advance notice before you redefer. If you came to us in January of 2023, that's too late. We can't push that out beyond 2024. 2024 comes, you're going to get your distribution. Now, we try to give you notice in advance. So this year, I'll be going out to people who are due a distribution in 2020 and saying, hey, by the end of the year, you need to tell me if you want to push that out farther. But that you also need to watch that yourself. Can't always rely on the fact that somebody's going to be watching this for you. It's something that'll be available to you online, and we can talk more about that. All right, so I'm going to switch. Slide 13 is a little bit of a veteran slide. In June of 2017, we made some changes to the plan because, believe it or not, up till then, you only had a choice of 5 years. You could defer it for 2 years, and then within those 2 years, you had to say whether you wanted it deferred for 5. At the end of 5 years, it was paid out. And, it was a good program, but it didn't allow a lot of flexibility or financial planning purposes. So we changed the plan in June to do this fixed date termination lump sum annual installment option, brought more flexibility to it. And if you have prior deferrals before June 1 of 2017, you can now go back and make those changes. And what I would encourage, if you do have that, give me a call and let's run through your options and your current situation of when you're going to get deferrals when, and we'll make sure that you have a good understanding of that. Again, it's a 12-month advance notice that we need before you can make those redeferrals. If you do nothing, then your original elections will take place as initially chosen. Couple examples on the redeferrals. Not going to spend a lot of time on this, but on chart 14, if you were age 50 in 2017 and you said, I want a lump sum 6 months after termination of employment, you could now come back and change that. You could say, you know what, I want to change it to a fixed date. I want to receive either lump sum or installments. Again, this is for people who have deferrals in the plan prior to June of 2017. And there's a lot of complexity around this, and we have specific forms that we use to affect those transactions, but we need to work through that together. And chart 15 in example 2, this is where you wanted a fixed date, but now you want to push that out farther. You can do that as well. Chart 16. Yeah, so prior deferrals, again, last slide on this, I think you need to have a plan. You can log into your account at Transamerica and look at it. You can, we'll be giving you information on the T. Rowe Price process, but you can make sure that you understand where you are with respect to that, and then complete the forms and accomplish your goals. This is the part where we talk about disclaimers. This plan is regulated by a plan document. You have that in your invitation. If you don't, I can certainly send you another one. The 401k plan is obviously highly regulated and also has a summary plan description and a document which you should have in your possession. We expect to continue these plans indefinitely, but we reserve the right not to. And before you enroll, you should always consult a financial or tax advisor. And nothing here is intended to give you tax or legal advice. Transamerica, your HR representative, nobody knows this plan like Ray and I do. So don't even bother giving them a call or trying to, you can look at your information online at Transamerica, but this plan is so complicated and needs a lot of care and attention that it's Ray or I who know how this plan works, and please feel free to give either one of us a call to help you through any questions that you might have related to it. It's not our intention at all to say, here's the plan, sink or swim. We want to make sure that you are comfortable with the decisions you make regarding your financial future and how you can best make this plan work to accomplish your goals. So I will now open it up for questions, and I'm going to stop the recording. Those of you listening to this offline, the presentation is now concluded.